analysis now. Michelle Schneider's with us, Market Gauge Group Managing Director. Michelle, are we talking ourselves into a recession?
Well, I think what we have right now is a dislocation, and that can happen in commodities. And again, I always like to go back a little bit in history at the only other time that we have seen something similar to what we have seen lately, which is back in the 70s. So you had the oil spike, and then after that, you actually went into a bit of a recession before you started with hyperinflation. And so if we like to look at one commodity only, let's forget about oil and wheat and copper and all of the classic ones. I like to look at sugar because sugar is a great tool to look at because A, it becomes in very high demand during troubling times, and B, there has been obviously shortages and great demand, although there's been a bit of a reprieve lately. But in the 70s, it went up to 65 cents a pound in 74. Then we experienced that recession. It dropped all the way to 9 cents. And then by 77, 78, in 1980, it drove back up to 45 cents when we had that big move up in the metals. And I think that's what we're seeing right now. We're seeing this dislocation. The fear of any recession, if it even comes to pass, to me, feels more short-lived to the stagflation, hyperinflation that I still think is coming, even though lately it's hard to make that case with something like copper dropping 32% from its high.
Away from the commodities, as you think about an equity allocation with maybe a hyper or a sort of a stagflationary environment, how do you allocate then if that's the scenario in which we prepare?
Well, again, I think you have to really measure everything right now in terms of raw materials because that's having the biggest impact on the equities market. Clearly, it's what's driving the safety to the dollar. It's what's driving the yields lower because people think the Fed's going to pivot, et cetera. But if we look at equities only right now, obviously we're still very much in a bear market. The rally that we're seeing even today is not completely unexpected with the yields falling. The question is going to be how long can it live? And again, let's go back. In the 70s, we had these gyrations, moves up from 5% to 20% in any given period of time where it then started to flatline. And I believe that's where we're going to go. Will it flatline at 3,600 in the SPX as we just saw recently? Will it flatline lower? Or will it flatline more between 3,800, say, and 4,020? That, I think, is right now what we don't know.
And Michelle, I want to broaden this conversation out and go cross-asset because you mentioned that bid into the dollar. And if I look at the Bloomberg Dollar Index right now, up over 1% at its highest level since March 2020, what are the potential ripple effects on that if you look across the asset landscape? Because dollar strength has really been a story for most of this year at this point.
Well, we can see that it definitely has destruction to commodities markets for one, and also the cost of our goods goes way up, so that's not going to be great considering we already have a big trade deficit, and I know we're discussing now with China in terms of easing some of the sanctions, and that might help drive the dollar down. But the dollar is something also that gets so seriously manipulated as its safety haven even. This is something that happened even in the 60s when the British pound got cracked and against the dollar. And the whole Bretton Woods thing was just to do the opposite, right? Was to bring gold down and drive the British pound up. So right now we have the dollar versus gold kind of thing. And I think what's going to be so fascinating to me is at what point does the U.S., even on the world stage with all the issues that we're having, and the dollar start to decline, and again, this whole dislocation starts to work itself out, and the real issues come back to surface, which of course is inflation.
It is inflation. You almost tempt me to go to the Great British Pound, Michelle, but we're about to discuss that any moment now. But for now, inflation, are you starting to reassess at what pace the Federal Reserve reacts? We've got the bond market currently, well, factoring in a rate cut as soon as 2023, mid-2023.
I don't think that the Fed is going to cut anytime soon. They have been very transparent. I think that might be the most positive thing we can say about them right now, in that they admitted their mistake about the transitory inflation, and they feel that the economy is in good shape. They've said that. So unless we really start to see a dive in the labor market, for example, I think that they're going to focus on inflation and continue to focus on inflation. They're not so much looking right now at the volatility on an intraday basis of whether gold is up or gold is down. They know in the long run there is definitely going to be a supply shortage, and that's going to continue, particularly if demand comes back on any level stronger than what it is right now.
Really appreciate it. As always, Michelle Schneider, Market Gauge Group Managing Director.